Okay, so welcome everyone. I'm Joanne Law, Director of Mediation Institute, and we're really excited to have Dean Crossingham join us today as a guest presenter. So Dean's an accountant and tax advisor who provides specialist tax services in relation to separation matters. Particularly, I imagine you do some other areas as well.
We do a few things. So this is all one of the areas that we
little specialist area. Now, my understanding is that you're the head accountant at Stanford Brown Private Wealth in North Sydney. I probably hand over to you to give us some of your expert information.
Fantastic. So I'll share my screen that I'm presenting on. So thank you very much for the kind introduction. So yes, I work with dispute resolution practitioners in helping them guide their clients through the tax consequences of relationship breakdowns. And that includes everything from the taxation of the division of assets in the relationship, all the way to helping clients lodge their tax returns during and after the separation process. And I've been working in the family advisory space for over 15 years. And for me, advising clients through a relationship breakdown is an area that is very important, as everyone on this call can agree to. It's emotionally charged. There is always a lot at stake for those involved. So it does necessitate proper care and expertise. And that is certainly the case when dealing with matters of tax through the separation process. So in this presentation, I'd like to run through a lot of the areas that I address with my clients when guiding them through a relationship breakdown. So firstly, I'd like to go through what tax concessions are available in respect to the division of the net assets and in separating a couple's finances. Then, even with the tax concessions that are available, therein lies hidden tax issues that do need to be considered very carefully. So I'll be going through those in a fair amount of detail. And at the same time, I'll talk about some alternative approaches to financial separation in a relationship breakdown, meaning that if the occurrence of tax due to the proposed financial separation terms is causing a barrier to the spouses reaching agreement, what are some different methods that can be used to financially separate themselves whilst providing an acceptable tax outcome to both spouses? Now, in practice, I would actually spend a very small amount of my time on working on the actual tax concessions themselves. Now, why is that? Well, it's because the concessions are not too controversial. Yes, there are particular details that do need to be addressed, and there can be some complexity, but very rarely does a client or their spouse actually object to the proposed treatment of a tax concession. The vast majority of my time is actually spent on navigating clients through the on-flow effects of these concessions and in helping them reach agreement with their spouse on the tax impact of dividing their finances. So let's go through the tax concessions now. And as we probably know, capital gains tax rollover relief is available when an asset is transferred because of a relationship breakdown. And what that means is that if there is an unrealized gain attached to an asset, i.e., if the asset has appreciated in value since it was originally acquired, then the CGT on that unrealized gain will not be triggered when that asset is transferred from one spouse to the other. Now, there are three very important points, and these are often very unappreciated points in respect of the specifics of the CGT rollover that is available in the breakdown. The first point is that if the rollover criteria is satisfied, then the rollover is automatic, meaning that no one has a choice as to whether the rollover applies or not. If the criteria is satisfied, then the rollover is automatically turned on. And the main criterion that will turn on the rollover is that the asset being transferred to one of the spouses must be done so pursuant to an order, a maintenance agreement, a financial agreement, or an award under the Family Law Act, or an order under a comparable state, territory, or foreign law. The rollover will not apply where assets are transferred between spouses under a private agreement, and that is even the case if the agreement is later ratified by the family courts. So in the first instance, the transfer of the asset must be done because of an order, agreement, or an award under the Family Law Act, so a court order applying to a prospective asset transfer. Now, the other main criterion for the rollover to apply is that the asset must be transferred to one of the spouses personally. It must be a spouse transferee, If the transferee spouse instead directs for the asset to go to a family trust or a family private company, or even to one of their children, the CGT rollover will not apply. Interestingly, the transferor can be an entity within the family group. So a family trust or a family company can be the transferor of that asset, although that may come with its own set of complications that I'll touch on later. But for the purpose of the CGT rollover, the former spouse has to directly become the new owner of the subject asset if the rollover is to apply. And lastly, if the agreement, order, award specifies the precise asset that is to be transferred to the spouse, then the rollover can only apply to that exact asset. So for example, if the order says that $100,000 worth of ABC shares are to be transferred from one spouse to the other, but the couple agreed to instead transfer $100,000 worth of XYZ shares, well, the rollover will not be available to those XYZ shares because they weren't the assets specified in the order. And I'll even expand on that by saying that if the court order, agreement, or award is erroneous in the sense that it identifies incorrect ownership details of the asset, the CGT event also cannot be rolled over, even if the intention of the order was very clear. For example, if the order identified the spouse's family trust as the asset's original owner, but in actual fact it was the spouse themselves that owned the asset, the rollover won't apply to that asset. So the court order, or better, the court order application, has to be accurate. Now, there's also an exemption for stamp duty. So no duty is chargeable on the transfer of otherwise dutiable property because of a relationship breakdown. And the requirements for this stamp duty exemption are not too different from the CGT rollover criteria, but at least for New South Wales stamp duty purposes, its application is just a little bit wider. So what are the requirements for New South Wales stamp duty exemption on the transfer of an asset in a relationship breakdown? Well, firstly, the property may be either matrimonial property or relationship property, recognizing property that is held during marriage or held during a de facto or a domestic relationship. And the stamp duty exemption can also apply to the assets transferred by a family company or a family trust. So at this point, the rules are just the same as the CGT rollover. For the stamp duty exemption to apply, the property must be broadly transferred to the former spouse or to their children, including a child maintenance trust if applicable. So this requirement is actually just a little bit wider than the CGT rollover, because for the CGT rollover, the asset must be transferred only to the former spouse. For the purposes of the stamp duty exemption, the property may be transferred also to a child. So in the situation that the property is transferred to a child, whilst there may be no stamp duty payable, there may be capital gains tax because the CGT rollover criteria will not be satisfied in that instance. And like the CGT rollover, the transferee of the asset cannot be a family company and it cannot be a family trust. And the final point I'll make regarding the stamp duty exemption is that the asset must be transferred pursuant to an order, an agreement, or an award under the Family Law Act, or as long as the commissioner is satisfied that the transfer was made for the purpose of a matrimonial dissolution. What is interesting here is that if there is matrimonial or relationship property that does go to auction as per a court order or agreement, and at auction it is acquired by one of the spouses, no stamp duty will be payable in that situation either. And it's fairly standard for a court order to allow a spouse to bid on their own property when it does go to auction in those circumstances. However, again, the CGT rollover relief certainly isn't broad enough to apply to a public auction. So keep in mind that under a public auction scenario, even though there may be no stamp duty for the transferee spouse, there will certainly be a capital gains tax for the transferor spouse, being the spouse that divests that asset. So I'll touch on superannuation very briefly in the context of a relationship breakdown. Now, in respect of member balances, yes, the member balance of one spouse can be transferred or split to the other spouse under a relationship breakdown, and there should be no adverse tax consequences. That is provided, of course, that the transfer of super from one spouse to the other is all done pursuant to the Family Law Act. Importantly, the superannuation member balance will retain its tax characteristics in the hands of the transferee spouse, that being its preservation status and the tax component proportions. So if the transferor spouse had already triggered a condition of release and can access their super, and that member balance is transferred to the other spouse, well, the other spouse will also be able to access that super, irrespective of whether that transferee spouse personally satisfies a condition of release or not. So likewise, when there is a self-managed super fund involved, an SMSF, and an asset is transferred from the SMSF pursuant to a payment split order, a CGT rollover is generally available provided that the transferee spouse discontinues to have an interest in that SMSF going forward, which is usually the case in a separation matter. However, where an SMSF does dispose of an asset and then transfers cash to the separating spouse's new superannuation fund, representing that spouse's member balance, the disposal of that asset by the SMSF will not attract the CGT rollover, which is a common misconception. So in a superannuation context, the rollover only applies to the member balance itself and to assets that are transferred to the spouse's new super fund, and not to assets that are sold outright in order to satisfy a member balance entitlement. So there are a few little nuances there that can cause some slip-ups if you're unprepared. So I'll go through a CGT rollover in a bit more detail by way of an example. So in this case here, we have Jack and Jill. In 2005, Jack married Jill, and then Jack acquired an investment property for $500,000 in 2007. In 2015, there was a court order under the Family Law Act requiring Jack to transfer that property to Jill. And then 6 months later, Jill sells the property for $1 million. So the tax consequences are the capital gain Jack would otherwise make is disregarded when he transfers that asset to Jill in 2015. Jill will inherit Jack's cost base in that asset for $500,000. Now, even though Jill has legally owned the asset for only 6 months, for the purposes of the 50% CGT discount, she's taken to have acquired the property when Jack did. So in this case, Jill can access the 50% CGT discount, which brings her taxable gain down from the $500,000 gross gain to a net gain of $250,000, which will be included in her taxable income when she lodges her tax return and assessed at her marginal tax rates. Now, if Jack and Jill instead arranged between themselves for Jack to include a capital gain in his return when he transferred the property to Jill, the ATO can still pursue Jill for that entire gain. And that is because, as I've said, the rollover actually applies automatically. So it would create significant exposure for the transferee spouse, Jill in this instance, if they did take it upon themselves to ignore the application of the CGT rollover. Okay, so that covers off the main tax concessions that I thought were important to talk about in respect of relationship breakdown. The main taxes that are always a high concern for clients are capital gains tax and stamp duty. And superannuation is always a key financial asset that is very often split upon separation. Yes, the tax concessions are great because we're not crystallizing any immediate tax. And as I've mentioned, there are always a few particular details that clients and their advisors need to make sure of in order to be eligible for those tax concessions. Joanne, I'll just ask you a question. Do all those tax concessions sound familiar in your experience as a mediator? And have you come across any in practice that are worthy to note on at the moment?
Yeah, no, well, very familiar. The only thing that was new for me was with super transfers that it's the entitlement from the transferee. But yeah,
that's right. So superannuation is an interesting one, and it turns on the complexities of tax laws and trust. The superannuation fund is a trust.
Yeah.
And what actually happens without the CGT rollover applying, if the member balance was transferred to a separate super fund, that in itself is a CGT event for that new super fund.
Yeah.
even though in reality, there's no real transfer of economic benefit to anyone other than the spouse whose member interest it is. But technically, it's a CGT event, so there must be a rollover, and that rollover is often interpreted quite broadly in any scenario for it to apply, but it's only a very specific case. But if the super fund sells an asset in order to cash out a member purely with cash resources, then there's going to be tax payable in that.
Oh yeah, no. So it wasn't the CGT, but I might have misunderstood. Did you say so? If the spouses are of different ages, so one's almost.
Yes, correct.
That one was new to me.
Yeah, that's right. So the superannuation benefit retains its tax characteristics from the hands of the former spouse to the transferee spouse. So yes, if the members the spouses are at different ages and the transferee spouse wouldn't otherwise have access to that superannuation, they may do if the transferor spouse did have access to that super.
Okay,
right.
Yeah, so that's very interesting. Well, we've had a pause. Does anyone else have any other comments or questions, Tricia?
I was the same, Joanna, on that one. So really simply, if one of the people, let's say the husband, is actually got a pension going into pension, you're saying that can go to a younger wife, for example.
Correct. That's exactly how it works.
No idea. Okay.
Exactly how it works.
Yeah.
Wow.
Notice you're worth your time here already.
Yeah.
And if you think of it in sort of the equitable principles of family law, that in the net asset pool, both spouses need equal access to the same resources. So it would be unjust if one asset was transferred to a spouse and that spouse couldn't access it until they reach their preservation age or retirement, for example, whereas the former spouse could access that benefit. So from my sort of my perception of it, it fits in with those principles of family law, and that's why that concession exists.
Excellent, thank you. Any other questions or comments while we've got a little brief pause? Excellent. Okay, proceed.
Perfect. I'll carry on. So I'll move into talking more on the hidden tax issues that occur and what some alternative approaches to your client separating their financial affairs, whilst at the same time trying to reach an acceptable tax outcome. And to start things off, I'm going to talk about latent taxes, which are sometimes called contingent tax liabilities. Now, referring back to the conversation on CGT rollovers and the example of Jack and Jill, rollovers are great because we are not triggering any tax liability on separation, but it must be noted that all we are doing by using a rollover is deferring that taxation to a later time. And in the Jack and Jill scenario, that time was when Jill sold the property after her separation was finalised, and Jill ultimately had to pay tax on that sale. So the CGT rollover itself is a hidden tax issue for the unsuspecting. By its very nature, a CGT rollover transfers that latent tax liability attached to the asset to the other spouse. The transferee spouse under a CGT rollover will effectively always pick up the former spouse's tax bill in relation to that subject asset. And when I talk about latent tax, I'm referring to the future or prospective tax liability that would be incurred should an asset in the property pool be sold or otherwise disposed of at some point in time in the future. But latent taxes can also extend to assets that are not transferred under a rollover, but are simply just retained by one of the spouses in the separation. And latent tax can also apply to top-up tax that is attached to retained earnings of a family company. And what I'm sure we're aware of on this call is that latent taxes are not automatically included as a liability when calculating the net value of a relationship's asset pool. So to walk through an example of how latent taxes can play out in a financial separation as a bit of a refresher, and what we have here is a very simplified family balance sheet allocated between what the husband will retain in the financial separation and what the wife will retain in the financial separation. And we can see that in the settlement, the husband will retain an investment property in a share portfolio and cash to the value of $4 million or 47% of the net asset pool, whereas the wife will retain the main residence in the family company to the value of $4.5 million or 53% of the net asset pool. So it's a very realistic outcome. However, If we now also consider the latent taxes that are attached to those assets, there are $100,000 of latent taxes attached to the husband's assets and a much higher amount of $1 million attached to the wife's assets. And those latent taxes have the effect of skewing the after-tax share of the property pool that each spouse will walk away with. In this scenario, because of the effect of the latent taxes, the husband's share increases to 53% and the wife's share reduces now to 47% of the property pool on an after-tax basis. Now, in this case, if you're acting for the husband, it's a very good result. But if you're acting for the wife, from a tax advisor's perspective, it's a pretty terrible outcome. So how are latent taxes actually taken into account in a relationship breakdown proceeding? So let's also refresh ourselves on that process. The Family Law Act provides for the 4-step process in the division of assets, and I'm sure we've all seen these steps before. So the first step is to determine the net asset pool that is available for division. The second step is to assess the contributions to the asset pool that was made by each spouse. The third step is to consider each spouse's future needs. And lastly, the fourth step is to consider whether the proposed orders are just and equitable to both spouses. The contention here in respect of latent taxes is, should the latent tax be included in step 1 and reduce the net asset pool that is available for division? Or if not, should the latent tax be instead included in step 3, if at all, when considering the particular spouse's future needs? For the spouse that will be retaining the latent tax, it is usually preferred and strongly argued that the latent tax should be included under step 1, because if it isn't, then the spouse will be burdened with the full tax liability in the future, that spouse retaining that asset. It will cause a reduction of that spouse's share of the asset pool on an after-tax basis, as I demonstrated in that prior scenario. And lastly, if the latent tax is included under step 3 in assessing that spouse's future needs, if it is included at all, then the latent tax is usually taken into account at a very general consideration in making a fractional adjustment to that spouse's entitlements. And that fractional adjustment is always of a much lesser benefit to the spouse burdened with that tax liability compared to including the latent tax at step 1. Okay, so as an accountant and tax advisor working in the family law space, this is the particular area where I do spend a lot of my time in advising on the tax consequences of property settlements. And I do that in preparation for court applications and hearings in terms of the actual structuring of the financial separation. But more often, my time is spent in the mediation process in helping the spouses reach agreement on the division of the assets that carry that latent tax.
That's really interesting. However, if an asset's being transferred and not sold for a period of time, how are you going to actually calculate that? Because it's going to depend on their income at the time.
Oh, actually, absolutely, and the value of that asset when it is sold in the future, absolutely, and that's where the ambiguity steps in, and that's one of the reasons why the courts don't allow the latent tax in those circumstances to be included in the asset pool. So the greater the vagueness and the unsure nature of the latent tax being incurred and how it can be quantified, then the less likelihood is your position including that latent tax in the net asset pool.
Yeah, so absolutely.
You're absolutely right, Joanne. Absolutely right.
And certainly in mediation, we should be identifying all of those assets where there's that potential, and encourage people to go off and see their accountant to try and get a measure on that. But yeah, very interesting about whether it's done at step 1 or 3. Any comments, thoughts from anyone else? Yeah.
So there are legal principles for including the latent tax in the net asset pool, and it reflects on what Joanne's just mentioned. So these principles are, of course, they're relevant if the matter does go before the courts, but they're also just as relevant in steering the mediation process by at least providing the legal parameters in order for the spouses to reach agreement. So what are the principles? The first is whether the court orders for the sale of the asset. If the court orders provide for the sale of an asset as part of the property division, then generally allowance under step 1 would be made in the net asset pool for any capital gains tax payable on the sale of that asset. The same applies if the asset is to be sold under a financial agreement. Now, the spouse and their team will still need to be cognizant that the tax liability needs to be calculated, exactly what Joanne mentioned, and it needs to be included in the net asset pool. So one needs to be very mindful that that is not overlooked. The next principle considered is the likelihood or intention of that asset otherwise being realised in the near future. So near being the operative word there, even without a court order. Now, that needs to be evidenced by the affected spouse. So relevant considerations here are not only the evidence relating to the intended sale, but also the purpose for the asset which was originally bought for. For example, whether it was a lifestyle asset or purely an investment asset bought for resale, with the latter being much more likely to be taken into account than the former. And the common scenario here is where one of the spouses having to liquidate their investments to either pay out the other spouse or to buy a new home to live in the absence of a court order or an agreement specifying that, in which case it is generally accepted to have a high likelihood of occurring and to be included as a liability in the net asset pool. And lastly, there may be a special circumstance in a particular case which, despite the absence of any certainty or even likelihood of a sale of an asset in the foreseeable future, where it is appropriate to take into account the latent tax. And that would be based on a case-by-case scenario, which would depend on the argument being presented before the court or otherwise being negotiated through mediation. And one such instance that I can speak of is when there is just a vast quantum of latent tax compared to the gross asset value of the pool that would make it clearly inequitable for just one of the spouses to be labelled with that future tax liability going forward. And a perfect way to demonstrate that a bit further is just to refer to some of the case law on the topic of latent taxes. The cases I've presented here, Rosati, Blake and Jarrow, they're all from the full family court. And although there are a number of cases that deal with latent taxes, I've selected these just to illustrate a few different scenarios. So in Rosati, which is actually the precedent case on latent taxes, the husband's claim to include latent taxes in the net asset pool failed because although he said he was going to sell his business and thus incur taxes, he could not give any evidence relating to that prospective sale. So as a consequence, latent taxes were taken into account so generally under step 3 of the step 4 process that the full court could not even identify how that was done by the trial judge. The full court basically said that if the trial judge said he took the latent taxes into account under step 3, well, he must have. So you need to make sure you have a strong argument with supporting evidence for the inclusion of any latent taxes to reduce the net asset pool under step 1. In the case of Blake, there was a number of properties involved in this case, and in the first single judge hearing, the latent taxes of all the properties were included to reduce the net asset pool under step 1 in favour of the husband who was retaining those properties. The wife had to appeal that decision, and she was successful in having the latent taxes for just one of the properties disregarded. And that appeal was successful because the husband gave testimony that his desire was to retain that property in the longer term future. He had already refused a purchase offer of that property, and the rental income from that property was actually his primary source of income that he relied on. So for all those reasons, the full court disregarded the latent tax from reducing the net asset pool in that instance. Though in Blake, there was a second property which the husband testified that he was going to specifically sell in order to raise the funds to comply with the separation order. And for that reason, the latent taxes attached to that second property were included to reduce the net asset pool, even though the sale of that property wasn't specified in the court order. So the lessons that I take from Blake are that leaving latent taxes to the judgment of the courts can be a hit or miss scenario. We have here the full court in Blake disagreed with the trial judge, and they are all learned experts, and even they came to different conclusions. Now, the latent taxes that were ordered to be repaid to the wife in Blake were about $100,000, and it took the wife 2 years from the date of trial hearing to the full court decision in order to secure that result, along with a considerable degree of risk on her behalf. I know from my experience, a lot of clients just don't have the fortitude to pursue that outcome through the courts, and they instead focus their energy on the mediation process and what is hopefully a quicker resolution, as long as they're supported by a well-advised team. And lastly, in Jarrow, what I wanted to touch on here is that in order for the husband to comply with the court order of a payment to the wife, he also had to raise some cash to do so. And this is the exemption that I alluded to earlier. There was actually a number of different methods that the husband could take in order to make available that cash, with each method having a different tax outcome, though the husband hadn't yet decided on the exact method that he was going to use. Now, because the husband's method was undecided, the latent taxes were therefore found to be so indeterminate and so vaguely possible that the court did not allow for any of those potential taxes to reduce the net asset pool, but they were instead treated under step 3 in a general reasoning for a 10% adjustment in favour of the wife. Now, you may have realised that this is distinct to Blake that I just mentioned. In Blake, the court accepted the actions of the husband in the prospective sale of the specific property to make his financial settlement, contrasting that to Jarrow, where the husband is uncertain as to his desired actions, and the court decision arrived at a very different outcome in disregarding the latent taxes. So from a tax practitioner's perspective, what do I think are the important points from these cases, and what do I think is important about latent taxes overall? So for latent taxes to be included to reduce the net asset pool, you need proper evidence the tax liability will be incurred. The tax liabilities is included from an expert opinion from a tax practitioner, and not to mention a testimonial evidence from the relevant spouse. And the corollary of that is that for latent taxes to be excluded and not reduce the net asset pool, you also need the proper reasoning and argument that a tax liability is calculated incorrectly or is not likely to be incurred. As Joanne said, latent tax should always be front of mind when dealing with the division of assets. So negotiating mediation, the ability of the accountant to help navigate, interpret, and communicate to one or both spouses and their advising teams on the matters of latent tax, and to assist in exploring alternative settlement arrangements, I have found can be a very important role in the mediation process. So let's look at an example now of the CGT rollover and the transferring of latent taxes. This time, the asset involved is a couple's main residence, which was first used as a rental property. A family home is usually assumed to be totally tax-free, but if the home was originally used as a rental property, then there will be latent taxes involved. So in this example, we have David, who acquired a rental property in 2010 for $1 million. David and Patrick started using the property as their main residence in 2012. The property was then transferred to Patrick under a court order, and Patrick later in 2015 sells the property for $1.3 million. Now, as I mentioned, the unsuspecting may say that because the property was Patrick's main residence at all times when he owned the property, then the sale should be CGT free. However, because of the CGT rollover, which is automatic, what Patrick must also take into account is David's use of the property throughout David's entire ownership period, which was for rental purposes up until 2012. And that was 40% of the entire ownership period. And in that case, because of the proportioning between rental property use and main residence use, it works out that Patrick will actually be assessed on a net capital gain of $60,000 when he lodges his tax return. That is even though the property was his main residence as at the date of sale. So what are the alternatives that David and Patrick can consider as part of their financial separation in dealing with these latent taxes? If the property is sold off as part of the separation, then there can be financial certainty for Patrick, as the after-tax proceeds will be included in the settlement. Or if the property is transferred under a private agreement, so not an award agreement or an order under the family court, David will pay the CGT based on the market value of the property at that time that the property is transferred to Patrick, and Patrick will get the market value of that property as his cost base going forward. Or otherwise, David may agree to compensate Patrick in the financial settlement in terms of a cash transfer or even other assets in compensation for the latent tax attached to that property that Patrick will be taking on. So there are a few things to think about in that example, but the first point is for the transferee spouse and their team to recognise that a latent tax liability will be transferred, even if the asset is being transferred under a CGT rollover, and even if the asset being transferred is one's main residence. So Joanne, before I do jump to the next slide, in terms of latent taxes, I'm happy to pause for any other questions. Latent taxes is usually a fairly hot topic in the separation mediation process.
Yeah, absolutely. It can be quite quite complex for people to get their heads around it. And yeah, I'm just thinking, I'm not sure that I always ask people, has their primary residence ever been rented out? So yeah, that's definitely a little trap for the unwary, isn't it?
Yeah, that's right. That's right. Okay, happy to jump ahead now and talk a little bit about when a family company is involved. So in a settlement scenario, when a family company is involved, so if a family company is to transfer an asset to a spouse under a relationship breakdown, a CGT rollover can also apply so that there will be no CGT on that transfer. And the same can be said if the transferor is a trust entity as well. In respect to the CGT rollover, what is important here is that in addition to the capital gain being disregarded at the company level, what also happens is for the shareholder in that company, the cost base of their shares are reduced proportional to the value of that property vis-a-vis the overall company value. So in the illustration here, we have Sarah and Julie who are separating. Now, under the court-approved agreement, the family company of which Sarah is the sole shareholder is to transfer a property to Julie. In that scenario, Julie inherits the same cost base of that property as the company had. So whatever amount the company bought that property for, Julie is taken to have acquired that property for the same amount and at the same time. Now, the market value of the property was 50% of the company's total value. So in respect of Sarah's shareholding in that family company, her cost base will therefore be reduced by 50%. And this is so Sarah is not advantaged at a later time if she was to dispose of her shares in that company in the future. Okay, so what's the hidden tax issues here? We understand that the CGT rollover applies and you may think, great, end of story. However, that's not quite the case. And that's because any transfer of an asset or payment by a company will still trigger a dividend even when the CGT rollover applies. Okay, and the dividend will be included in the recipient's taxable income. In the instance where the transferee spouse is a shareholder, an ordinary dividend will still arise in the hands of the transferee spouse. In the instance when the transferee spouse is not a shareholder, well, the payment will be treated as what we call a deemed dividend, and it will still be included in their assessable income. And to make matters worse, the dividend amount does not take into account the cost base of the property. The dividend amount will be the property's full market value. So if the property is worth $1 million, Julie here in our example will be assessed on a dividend of $1 million, even though the CGT rollover applies, which is not the best result for Julie. So very clearly not the best result. So if we now look back at the division of the net asset pool, Julie does have a case here to include the tax liability on this dividend to reduce the overall asset pool value because the tax will be incurred due to the court approved agreement. And Julie would look to include the tax liability to reduce the net asset pool if it was in her favor to do so. And likewise, Sarah could even seek to include Julie's tax liability to reduce the net asset pool if it was instead in Sarah's interest to do so. And the same issues can arise when we are dealing with a company that also has a trust structure involved. But to begin with, it's always required that the spouse and their advising team recognize that that tax issue exists and for it to be addressed as part of the mediation process. So what is a wrap up of the key alternative approaches that can be taken into account so as not to be surprised by the hidden tax issues in a relationship breakdown? Well, firstly, instead of transferring assets from a company or a trust or dealing with the adverse dividend issues that I've just mentioned, you could instead change the control of that company or the trust to the desired spouse. A change of control of a company can be effected by a change of shareholders. The rollover should be available to any CGT upon the transfer of those shares without the unwanted dividend consequences. In terms of a family trust, you could consider changing the appointor role of that trust, provided, of course, that the trust deed allows, which should effectively change control of that trust without any tax consequences as well. Can the dividend be franked? Yes, it can. Question coming through on the chat. Now, instead of a family company paying a dividend to a spouse, this would occur, for example, where there is a family company with retained earnings in the form of cash, and that cash needs to be divided or the transfer of a property owned by a company. The issue here being that for the spouse that receives the dividend, there will be the top-up tax at the marginal tax rates that we just went through. What is an alternative approach to consider here is actually establishing a new structure for the recipient spouse, be it a new family company that they control or a new family company with a trust structure in order to receive that dividend, with the intended outcome being that no top-up tax will be paid by the recipient spouse until they actually draw that money out of their new structure. But in the meantime, the structure can serve as their investment vehicle to accumulate wealth. So that doesn't eliminate tax, but that certainly defers it even further into the future. The next alternative that I wanted to flag was that instead of transferring an asset subject to a CGT rollover and potentially distorting your client's after-tax share of the asset pool, you could consider transferring the asset under a private agreement, because of course, if the transfer is pursuant to a private agreement and you don't go through the family court, or even if it's later ratified by the family court, then the CGT rollover will not be available and any tax on that asset will crystallize in the hands of the transferor spouse. So private agreements are always an option to consider. And lastly, the simplest alternative is often the best. So instead of transferring assets with the latent taxes attached, look to adjust the cash payments to complete the financial separation or to move assets that don't carry latent tax, if possible. So clearly, when there is simply a transfer of cash from one spouse to the other, we won't be dealing with any tax consequences of moving around assets. So utilizing cash transfers is always an approach that should be considered when possible, but of course, there needs to be sufficient cash or assets with minimal latent tax available to do so. So Joanne, I'm sure some of these alternative approaches do sound a bit more appealing than dealing with unwanted taxes.
Yes, absolutely. So when you refer to private agreement, do you mean a binding financial agreement? Or?
Yeah, I do. So it can be just a personal executed agreement that they're legally bound to and not going through the family courts, or it could be a financial agreement that they've entered and executed and acted on that is then later ratified by the family.
Okay,
courts.
because if it's done after the event, they don't get the CGT.
That's right.
Yeah.
That's right. So you still have all the legal standing of what you otherwise would, but getting that process a little bit turned around in order to have the desired tax result. Excellent.
Any questions or comments as we go through AFF, wherever you are, with the franked dividend? Was that clear? Yep. So for anyone,
that's right. So dividend can be franked. That's right.
So, can I ask a question, Dean? So often when I've got clients and the other partner has all the businesses and all the property and all that, they just pay money over this way. And I usually find that they know that there's latent tax, they know that there's all of the taxes, but they just consider it's their business, so pay that person out. It doesn't go on the table, it's not negotiated, but I know, like, we just assume that they know it, right? It's not put in the orders. Is that okay?
Well, it's okay as long as it's acceptable to both spouses. That's
it's not
what makes it okay.
Because one party does the business and the other party's never come across it before. So it's never put on the table, but I suppose it's assumed that the person who's retaining all their businesses knows the tax structure.
Yeah, and that's probably the point that needs to be confirmed with the client, instead of just perhaps assuming that the client understands the situation, assuming that you're representing that particular spouse, is to ask them, do you realize that you have latent taxes attached to your business structure? And is it worth considering for these latent taxes to be taken into account in dividing the net asset pool? It's certainly a question that I ask my clients when I come across that scenario.
And if you're advising the other party?
if you're acting for the party with the latent taxes attached, then you certainly
without any taxes.
Oh, without any. So if you're representing the client without any taxes, then by including the latent taxes, it will reduce the net asset pool and therefore reduce their share of that asset pool. So you probably wouldn't mention it, no.
Yeah, that's what I'm saying. There's nothing legally wrong with not mentioning it, other than just mentioning that it is there.
No, yeah, there's I'll probably defer that question to a legal advisor as what is acceptable to mention and what mention, but certainly from my perspective as a tax advisor, you're not even entitled to advise the other party as to their affairs. So I imagine that would be the same concept in law.
Yeah, and as a mediator, we're working with both sides, so we'd generally be asking, are there any tax consequences? Have you, and when there's assets that we know are going to have the potential for capital gains, so investment properties, businesses, and in future, has the house ever been rented out in the past? Then and then it's up to the parties to make the inquiries. I imagine a lot of times with those businesses, they're not imagining that they're going to be selling the business at any time in the near future. So it becomes difficult to quantify as well. Yeah,
that's right. And I guess it comes back to the quality of the advisors supporting that particular spouse and how they explore the issues and present the issues in the mediation process. So absolutely the key issue in mediation for me is usually the latent taxes. Okay, so I hope we're going well for time, probably another 10-15 minutes left just to get through this separate part. So moving away from the division of assets slightly, the final thing that I thought was important to touch on is the scenario where your client is the spouse who was not historically in control of the family's finances and had very little visibility over those finances. From my perspective, having an accountant who is independent from the incumbent family tax agent in attending to the tax returns of your client during the separation process, as well as lodging their tax returns after separation, whilst there is spousal and maintenance payments being made, it's extremely important in giving your client comfort on some of their most immediate financial issues. And what may be some of your client's fears and issues regarding the tax returns? And from my experience, how can these fears and issues typically be addressed? Well, during the separation process, there is the fear that the other spouse is shifting tax to your client on family income by way of their tax returns, whilst that other spouse still has an influence on what is included in your client's tax returns. And an inclusion of any additional income in a tax return will likely increase a tax liability and cause cash flow issues for your client when they do lodge their tax return. And when I'm talking about family income, I mean income paid from a family company or a family trust and so forth. And it could be paid by way of a salary, dividends, or trust distributions. And usually in such circumstances, your client does not actually receive any of that income directly, if at all. In terms of the issues after separation, there is generally concern about how family income is going to be again used and declared in your client's tax return in relation to the ongoing spouse or child maintenance payments, especially when it has been provided for in the financial agreement that your client will receive family income in respect of those or in lieu of those maintenance payments. So what are some of the alternative approaches to manage and navigate those issues during the separation process? Well, if the spouse is seeking to include any family income in your client's tax returns during separation, it's a matter of identifying what is the disadvantage to your client by doing so, and to then make sure that your client is adequately compensated in the settlement for the inclusion of family income in their returns. Or better yet, is for your client to be immediately compensated for their tax liability. And the tax administration process and tax laws can help your client in that negotiation. And a very simple approach that I've seen work very effectively is where your client takes a position that the family income will not be included in their tax returns. And that is effective under the scenario that the other spouse is usually motivated to use the lower marginal tax rate of your client. So it is still within their interest to meet the compensation needs of your client. And also, if there was discrepancy in the overall family tax lodgements, that can attract the unwanted attention of the ATO. And generally, that's a situation the spouse does not wish to be drawn into, as you can imagine, and that certainly helps in delivering an adequate resolution to your client. Now, in terms of dealing with the tax issues after separation, with the family income being diverted into your client's returns instead of, well, in lieu of maintenance payments, generally, spouse and child maintenance payments should be tax-free. However, it is not tax-free if the payment represents income that the other spouse would otherwise have to be liable to pay tax on, which would be the case on income from a family company or income from a family trust. In which case, the amount of any such payments would be included in your client's tax returns, and they would pay tax thereon and obviously cause a disadvantage to your client. So if your client was to agree to such an arrangement, to include family income in lieu of maintenance payments, it is always recommended that there is an emphasis on what indemnities are provided to your client in the financial agreement to give protection to your client. They will not be left out of pocket due to any later tax liabilities. And further, if there is questions over the reliability of any indemnities, then it is recommended that a tax installment amount be included in any ongoing maintenance payments, so your client is not caught with a shortfall upon lodgement of their tax return. So that's just a few tips from my experience when dealing with tax return lodgements during and after the separation process. So Joanne, that does conclude everything that I thought was important to go through today. The main points being that tax concessions are available and are a really great tool to remove any immediate tax consequences, but there is still a lot of hidden tax issues to deal with. And likewise, there are alternative approaches to consider in navigating through those hidden tax issues. So happy to pass it back over to you now, Joanne, just to take any questions, whether there may be any.
Yeah, excellent. Thank you very much. And that really was excellent. As a mediator, I'm always encouraging people to go and get tax advice. But after that presentation, I'll be encouraging so much more, because you've really demonstrated the value of that sort of information. Does anyone have any comments or questions about what Dean spoke about, or something else that's relevant that that you might want to know about, or even let him know if you found what he's shared helpful? So feel free to take off or turn your camera on and or chat. Use the chat. Yep. So so Lena. Yep. Yeah.
Look, I'm happy to. Very contactable after the call today, should anyone wish to reach out with any inquiries, whether it be a professional sounding board in respect of a financial separation strategy, or expert review of financial disclosures of the balance sheet, or any type of formal tax advice or lodgement of tax returns. We'll be very pleased to assist and be a collaborator with your client, with you. Excellent. And how's the best way for them to contact you? Well, should we circulate my details on an email after the call, Joanne? I think that would be a really good way. And I'm happy to put a link below the video as well, if anyone does want to get in touch. But I'll send an email around and probably a link to your website. Perfect. That would be great. Yeah, okay. Very helpful. Any other comments or questions? No.
I was just going to say thank you. That part around the super and pension, I've never come across that before. So that's really interesting.
Yeah, exactly. Very useful. Excellent. Well, in that case, if there's no more comments, I think we'll call it a night. And thank you so much, Dean. It really was very helpful. Thank you. My pleasure, Joanne, and thank you for everyone on the call for attending. It's great to add some value, and I hope you found it useful.